Excited to be able to present to you all today. A little bit about myself. I am the VP of Development on the BSA side and also the Executive Director on the BSA Foundation side. I also am on the National Board for Charitable Gift Planners and serve on the Executive Committee. And I'm actually the Conference Chair for next year's conference in Florida. And so I've spoken at both national conferences as well as several local conferences. And so ironically enough, I'm supposed to be traveling up to Minnesota because I'm actually going to be doing an event with the Financial Planning Association, specifically around IRA giving and QCDs. Any one portion of this presentation could be an entire presentation, recognizing that the goal is to do a 30,000 foot overview of many of these areas. Please feel free to ask questions, and at the same time, know that this is kind of scratching the surface, and that is where Bob, Art, Jenna, and Mario really come into play in terms of furthering those conversations. But it's my hope to whet your appetite the way that an appetizer is not the meal, but really kind of bring some of those ideas to the forefront and then move things along. With that being said, I'm going to go ahead and share my screen and jump into this presentation. All right. So even though I'm not there with you guys, I've decided to travel to DC. So I'm there with many of the landmarks on stage and everything else. With that being said, I titled this, instead of just going with Planned Giving workshop, as Creating Friends of Scouting Forever. And what we'll be covering today is planned giving and endowment opportunities. So if you want in the chat, does anybody have a clue what this picture actually is? You may at least have some guesses or whatever. But here's some course overviews. We're going to be covering legacy planning, how planned giving can make you happier, why endowments are important, becoming less philanthropic to the government and more philanthropic to scouting, estate planning opportunities for legacy giving, and then at the end, some simple best practice concepts for maximizing your giving. With that being said, do we have anybody in the chat make a guess for me? Let's see what we had. I don't know if anybody made a guess. So this right here is Cheers. That's actually the original bar that Cheers is actually based on, and they're holding up a sign that we win. And I want you guys to know at the end of the day that planned giving and creating your legacy for the council, supporting scouting, is really a win-win proposition. Scouting is a love for you, and the community that it actually has needs scouting. And so legacy gifts to scouting really do make that impact. Following up on the statement, we got Cheers. So feel free to chime in with questions, whether in the chat or maybe Jenna or Bob can let me know if something's in chat where we need to pause and maybe answer a question or two. But with that being said, let's jump right in. So the first thing is to recognize that there is a lot of wealth passing between now and 2061. Thinking about yourself, how is your legacy planned? And, how do you fit in that concept of over the next 30 or 40 years, your wealth passing along? And in terms of the council, it's going to be a significant component of our future is how many people that love scouting today help support the future of scouting in the DMV area. What statistics say is that 75% of millionaires and billionaires leave money to their children. One of the questions that's always out there is, but are those children prepared for the wealth that's brought in there? And that really comes into play when it comes to, strategies like charitable gift annuity, charitable remainder trust, or strategies that actually allow for children to get income, but not actually receiving, the big pot of money all up front, where the Maserati effect and other things kind of really fall into play. I always throw this out there when I speak to people, even in a financial planning context or even a philanthropic context. It's easy to leave valuables to others, but how do you leave happiness, fulfillment, and values to those that come after you? One of the concepts that really gets interesting is how do you integrate your children into your philanthropy? And even though we're talking about planned giving today, one of the major concepts is supporting scouting by accelerating some of those planned gift creations so that your children can be involved in that process and see the impact of that philanthropy, so that it isn't just something that happens after you're not here. Tonight, we're really going to be focusing on that idea of moving your loyalty. I mean, the fact that you're even on this call, I couldn't imagine how many years of volunteership is on this call this evening. But how do we move that loyalty into passion and moving it from the head to the heart, where they say that 80% of decisions are made by the heart. But we always, when you think about planned giving, there really is an emphasis around the numbers and everything else. The reality is, if we're not focused on the impact that scouting makes, you won't decide to make that decision. So the reason why you're here is because you were involved in scouting, and scouting made a meaningful difference to you. And I recognize that as we talk about this and lay the foundation for some of the tools. You don't need a hammer if you don't have a nail and a picture that you need to hang up on the wall. And so it's important before we go into tools that we kind of lay that level set. So I think what we heard from other folks, from Mario with 200 million, is to think big. And it's my goal to have you think about reasons to give to scouting now as well as later, because planned giving covers more than just estate giving. And there's a plethora of ways for you to think about both of those. So in terms of community impact, and that being the goal, what impact do you want scouting to have in the community in the next 5 years? In the next 10 years, and even the next year? When Mario described the $200 million, what that really boils down to is a very simple factor. Believing in the future of what scouting can be in the community, and then building that process out. And then more importantly, what are the resources that are needed to get there? And that really is the crux of what John Honeycutt described when he was talking about what's your plan to get to 200 million. Part of that plan is having a strategic vision that shows a $200 million need from an endowment standpoint. So the importance of endowment, I know this is what you're thinking. Why another initiative? Why endowment? When Mario threw the 200 million, I'm sure one or two of you were like, 200 million, where's this guy getting this stuff from? So I show this really quick slide. I was in supporting Mecklenburg County in Charlotte, North Carolina. And what we had done was they had an outreach program that, used to be financed primarily through United Way. And one of the goals was, as a portion of their long-term strategic vision on the council, was looking at what happened to United Way funding, and then recognizing that as the United Way funding went down, yes, investment income went up, but not at the same level. What's missing is kids that are not being impacted when we don't have the dollars to support them with our programs. And so, that is the big sale point of what we're trying to do, is making that sale on the impact that scouting has, because it's not about dollars. It's about that return on impact in our communities. All right. So the need for a larger endowment. One, capital projects don't maintain themselves. I just heard a number of $2.4 million per year. $2.4 million per year. That alone basically boils down to, what is that? 20 million, 30, 40 million. Like, that is a $40 million campaign on its own, or something like that. And that's just looking at the camps. That's nothing else besides just leaning into the approach of being a friend of scouting forever and ensuring that the camping operations are kept maintained, and a thriving experience for youth that attend there. And I can speak to it because my son actually attended camp there last summer. Endowments themselves are current living and breathing sources of income. And then what does an endowment do now? It's the impact that you make with the endowment now, but as the endowment grows, what does that mean? What we just saw this past year in terms of inflation is 8% inflation. So if we're not growing our endowment by 8%, and we just saw the stock market go down, which means that donations are the way that you do that, we're having lesser of an impact from an endowment standpoint this year versus last year. And that's why this focus, an annual focus that the council actually has. All right. So my quick case for endowment. So the first thing is, what would be the impact of the council having a larger impact, larger endowment to support the programs and the services, right? I just said that just one line item, $2.4 million in maintenance, that would have an impact that we can ensure that everything is well maintained. You know, you grab other aspects of the program, the outdoor operations, et cetera. You know, the gentleman talked about Camp Snyder and having a more thriving program. What would it look like for someone to endow, you know, all of the programs necessary to have a thriving camp there, and all of those other dynamics. All right. As you can tell, even though Jenna did not tell me to keep doing this, I keep throwing this out there because that's what I'm trying to set the stage for, is for you to think big. So the council size of their endowment is $10 million. So what would a $10 million gift do for this council? What would $10 million do for Georgetown? Which has a greater impact? Which would be more transformational? That's the sale. The sale is a $10 million gift is a game changer for us. A $10 million gift at Georgetown is Tuesday or maybe Wednesday. And really being able to not only have you on this call make a gift yourself, but be an advocate for sharing that message of impact and need when it comes to an endowment. And then it's not about the size of your gift. I've talked about 10 million. You're thinking, man, I was thinking about 50,000. It's that we have you in the ship. We have you on the boat, and we can actually share that message on a continuous basis from a forever impact on the council and our future strategy. There I go, pulling information that I was able to grab myself. So $105,000, you know, what does that look like? That's what, a $5 million endowment just by itself to support, you know, and just think about what are these things? What does this mean in terms of dollars? You know, $300,000 for, you know, that's what it's yielding off. But we just saw the budget was bigger. So how do we continue to grow those efforts? You know, there's major opportunities that are endless. More importantly, there's a bucket that is sitting out there with a blank name on it. Your family name is sitting out there, and those opportunities to have that kind of impact on the council. I threw out some ideas. They didn't ask me. I just went ahead and threw some ideas out there. What about someone that wants to, you know, endow the Silver Beaver Award dinner? Or what if someone wanted to, you know, endow the Eagle Scout recognition dinner? My guess is in Washington, D.C., these are probably really low numbers. So that 250 is probably, you know, that $12,000, that's probably a joke to you guys. But I was thinking about you when I created this. But just thinking about subcategories and ways when you're making your gift that you can think about what kind of impact it can actually have to the annual budget from an endowment perspective. All right, so here's where the fun starts. I've got you thinking about pulling out your wallet. Not really. John knows me specifically that the wallet is not where you make the greatest gift. 9% of wealth is held in cash. 91% of wealth is actually held in assets. And I even have another fancier chart for you. It shows that as you go up the food chain in terms of net wealth, liquidity in terms of just actual cash dramatically increases, and now comes into play of, you know, stocks, bonds, mutual funds, et cetera, where there are more tax efficient strategies and approaches really become more impactful in that journey. And so no need for you to try to read this all the way. Just trust me, that's what it's actually sharing. But I do think it's actually really valuable for you to understand that, I appreciate this council leaning into the idea of getting out of just the cash business and getting into the asset conversation. So how do we spend our time? So the reality is 10% of wealth is held in one bucket, and 90% of wealth is spent another way. But us as fundraisers, we spend most of our time talking about cash. That's just the reality of what it is. And so, like I said, I really do appreciate this council leaning in on the idea that those conversations need to take place beyond cash. All right, so gifts of stock. They're normally referred to as a long-term appreciated stock gift. So long-term means longer than 12 months. And that makes a significant difference. If it's shorter than 12 months, you basically get cost basis. That's not good. Appreciated, also important. If you have a stock that's went down in value, you hate it, you lost money in AT&T, it just went down over the last 5 years, etc. That is not the gift that you should make. If you have a loss on it, you should sell that asset. You can decide to give us the cash afterwards, but you can't claim the loss without selling the stock itself. And then generally speaking, most of those gifts are going to be publicly traded. When it is actually a piece of closely held stock, there's a very different process that we're not going to be covering this evening. Just know that when we're referring to gifts of stock, we're generally talking about publicly traded stock. How it works is the donor is actually the donor actually gives us the gift, right? The donor gets the tax deduction, then we receive the gift. Here's the interesting part. We're able to sell the stock and there's no capital gain. More importantly, it's because we're a nonprofit, they're not charging us any tax either. And so that's where that dynamic really comes into play in terms of, looking at your portfolio. And you may own some of these stocks or other stocks that I'm going to show you on the next slide. But the thought is, whether it's a small gift or a large gift, unless you've maximized your taxes in that way, it may make sense for you to think about making a gift of stock instead of just making that gift of cash. All right, so I went ahead and pulled direct numbers, and you can see I was working on this presentation, or at least making updates as of yesterday, which was tax day. So one is Apple stock. In 1991, in December 1991, that stock cost just split adjusted was 41 cents. Today, I meant to change that number because it's now $166. I don't know how, but it's $166. So it's even more than what I have listed here. Disney stock actually, it was $98.48. Today it was up at a crispy $100 versus the $8.33. And then Microsoft stock was $1.45 on December 31st, 1991. And today it's $288.80. Or yesterday, I think today it's $287 and some change. The point is, if you're sitting on a stock that you own since the 80s or 90s, there is a potential approach where you don't have to be philanthropic to the government, even if it's just making your annual FOS gift. Jenna would love to talk to you about a transformational gift to scouting as you navigate the tax winds and avoid philanthropy to the government. But the point is, that is one way to look at your assets in a way that you may not have before. So just kind of making sure you see the dynamic. Person sells stock proceeds. It's 110. They were going to owe $20,000. The net proceeds after the sale is $20,000. We call it a missed opportunity. I would actually call that philanthropy to the government, but I don't know, they could be bugging this conversation, right? And then on the other side, if the gift is made to charity directly, that's $110,000, and that $20,000 of capital gains avoided really is just philanthropy to the government that doesn't happen. In many cases, what happens with the donor is if they were to sell the stock and then give us the net proceeds, they may be left with a tax bill at the end of the year. that they could have done something slightly different. So it's just something to keep out there, think out there as you're making a gift or thinking about a contribution, or the council leans into a capital campaign. Before you make a gift of cash, are there some other ideas out there? I went ahead and put some other thoughts related to, gifts of stock. One is a stock replacement strategy. What that looks like is you donate the stock, and then you use the cash that you would have used to donate to the council, and you repurchase the shares. You can almost do that in real time in terms of donating the stock and then buying it back. What does that actually do? Now your new cost basis is $288 in the case of Microsoft. And on the other side, the council was able to receive that same gift, right? So the council, whether you gave them $10,000 in Microsoft's shares or $10,000 in stock, relatively speaking, they received a $10,000 gift. You, on the other side, owned a stock with a $2 basis, and that was worth $280. You avoid $286 of capital gains. That is a significant difference. And it's something to at least put out there. I caveat everything with speak to your financial advisor about any of these strategies, but it is something that I've heard from many financial advisors as a strategy that does make a lot of sense when it comes to philanthropy and raising the cost basis of their portfolio. The second one is a stock portfolio rebalance. What that looks like is, from time to time, your stockbroker, investment advisor, financial planner is looking to kind of whether it's divest out of a certain stock because you own too much of it, or at least rebalance your portfolio. If at that same time you were thinking about making a gift, to the council, you were going to be that $10 million giver. Instead of doing that, via cash or, some other form of liquidated asset, you would have the ability to donate those shares. And then now with the cash that you would have already used, you can now use the cash that you would have donated to the council and use that to rebalance, and buy bonds or whatever it was that you were doing from a rebalancing perspective. It's just something to put out there and something to bring back to your financial advisor. If you hear rebalance and you were thinking about making a gift to the council, ask about it. And then the third one is bunching. Bunching primarily looks like when they changed the tax laws a few years ago, in 2018, for a lot of people that were taking a standard deduction, the standard deduction, really moved up the threshold where they're really on that borderline between itemizing and just taking a standard deduction. In general, what may happen that makes a lot of sense is to give a substantial amount of the gift that you'd like to do from a charitable perspective in 1 year, and then in the 2 subsequent years or whatever that time frame, allow that gift to be the thing, right? Jenna, I'd like to make a 3-year commitment to the council that covers, my FOS or whatever commitment I'd like to make over this 3-year time frame. You get the, entire deduction. Let's say it was 10,000. It's 10,000. You were going to give a year. You give a $30,000 gift. You now move into the threshold of itemizing, right, in that first year. And then the next 2 years, instead of making a charitable gift, they continue to steward you. They continue to bring you to events, et cetera. But in return, now you can take the standard deduction in a way that makes a lot more sense. We could probably go into a lot more detail. There probably would be a lot of questions about it. But the idea is looking at your taxes, since it was just tax day, and just thinking about that idea of, can you accelerate your giving so that you can maximize, your contribution to the council. And I don't think, Jenna, that you'd ever turn down if someone wanted to give you this year's gift and next year's gift. Would you turn that down?
Absolutely not.
Okay, just checking. I wanted to make sure. I don't want to speak for the council, but I was pretty sure if you want to give 3 years worth of giving in year 1, I can't promise you that she won't ask you in year 2, but you can remind her. So there you go. All right, so gifts of real estate. From a gifts of real estate standpoint, first thing is more than 12 months. Same exact concept. The second one, again, The tax deduction, you give $100,000 in real estate, it equals $100,000 tax deduction. There are some restrictions around, if that $100,000 represents $100,000 in income, you kind of get into a weird dynamic. So do talk to your tax advisor, but the general concept is also true. And even if you ended up using all of your charitable deductions in 1 year, those charitable deductions can also carry forward for a couple of years. The third one is it may take some trouble, but it can be worth it. What if the property, there's some questions that you may ask. What if the property sells for less than the appraised value? There's definitely some things that you would want to talk to your tax person, but in essence, let's say you donated a piece of property. You donate it to us and your appraisal said it was worth 500. Jenna immediately sells it for 300. The IRS may look at you and say, was this property worth 300 or worth 500? Your relationship with the council and allowing them to have a cure period so that they can sell it for, optimize the sale is also very important. But the real primary goal, and the government understands, when you give to a charity, it might be worth 500, but they may sell it for 450. What they're trying to avoid is you find your cousin Sal, who appraises a property that's worth 100,000 for $1 million and taking that deduction. That's when it really does come into play. But do understand that there is a dynamic there, and it's also worth talking to your tax professional in addition to trying to have the conversations with the council or any charity that you might try to make a real estate gift with. Now, the next part. Here's some other considerations, whether you tried to make the gift through the national office to support, whatever inside the organization, or, some kind of thing where you're trying to support the council, et cetera. One, you will need an appraisal. It is virtually, let's call it, it's impossible for you to do a real estate gift and not have an appraisal, unless you want to try to test your luck with the IRS auditing you and you not being prepared for that conversation. Number two, depending on the institution, most universities, the national office, they will likely require an environmental report. There are some exceptions. For instance, with the BSA National Foundation or the National BSA Foundation, if it's a property that's located in a neighborhood, i.e. residential, we may have an exception specifically around needing an environmental report. When I worked at the university, we kind of had a rule, which was there was no exception. So you needed a phase one, which costs about $3,000, which makes it very cost prohibitive at times to make a real estate gift, but it's just something to know out there. And then the last part is you need to have an agreed upon plan on how to cover expenses on the property. It may be that you say, I'm giving you this property and that's what's going to happen. And the council or the organization that is receiving it may say, you know what, it's a $500,000 piece of property. You don't need to give me anything. We have the reserves to pay for it. On the other hand, you may offer that and they may gently or emphatically decline in receiving that property based on the possibility of it. So it is a work in progress. It is a discussion, and it's not something that you can just immediately do. So it is definitely not it's December the 20th. I'd like to make a real estate gift. I just need the council to accept it so I can deduct it on my taxes this year. Kind of dynamic. There's definitely more lead time with that process, and it really is an agreement between yourself and the charity. Life insurance gifts. Just a couple of quick notes. Sometimes you can do an existing policy with premiums owed. Once again, that's a conversation and an agreement by the council or the charity in terms of being able to receive that. Some cases, they may take the existing policy with premiums owed and they may pay the premiums on their own. They may immediately sell it. It really depends. The second one is a paid up policy or a new policy. That is something that can be received as a gift. Once again, that agreement has to go with yourself and the charity. And then the last one is life insurance can be used to replace other gifts or protect pledges. So the same way, hey, look, I'm making this $1 million gift. I want to ensure that you receive it because you put my name on the camp. And so you may actually get life insurance to back up the pledge. And then once that $1 million gift is received, they will try to beg you to keep it to the council. You may revise the usage of it and transition it back to a family member, et cetera. But it is a strategy that's out there. Just generally, I wanted to have a couple diagrams. So this one is insurance. You're giving it over to the BSA. They can keep the policy. They can cash it in for the cash value. That's one way that it looks. Another way is donor makes a gift to the BSA. And then they actually, on the other side, decide to buy life insurance so that they can replace that money. At times you have children that are like, why is dad or why is mom giving her money to the Boy Scouts? I mean, I'm an Eagle Scout too, but I need that money. And so there are strategies that you might deploy from an asset protection standpoint or an asset replacement standpoint to make sure your family is receiving what you believe is the legacy you'd like to leave there, while also being able to make a gift to the BSA. And so life insurance can play a vital part in that process. IRAs. So retirement plans are not inheritance plans. Why do I say that? Because they can be hit with both income taxes and estate taxes. They're normally or often the worst thing you can give to your heirs. I know it feels like it's stock, but it doesn't tax like it's stock unless it's a Roth IRA. And it's one of the best gifts that you can give to charity. Once again, the goal is being philanthropic to your charity, not being philanthropic to the government. And so the last part is some can direct up to $100,000 a year from their IRA to the charity. We're going to say the Boy Scouts of America National Council, right? But that is another component there. All right, so QCDs are normally where that conversation really lifts off. And so I was preparing for a future presentation. And so you guys are going to get a couple slides about QCDs. I think there's a lot of value here, though. The first thing is a QCD is available at the age of 70 and a half. And it's a gift that can be made every year up to $100,000. If you have RMDs, but you're over 70 and a half and you have required minimum distributions, that becomes one of the ways that you can meet that required minimum distribution threshold. It allows you to give the money pre-tax. So if you think about the fact that when you put in a gift or you put donations or deductions inside of your IRA and you're saving that money, you weren't taxed on it going in. The government is looking for their money. However, they are willing to make an exception when it comes to giving that gift to a charity. That is a very big deal for many people in terms of paying that tax. And that is actually different than pulling the money out and then gifting it to charity. And so there is a nuance there, and there's receipting and everything else associated with it, which we'll share a little bit. In many cases, if you are over 70 and a half and you're like, I only give $5,000 away to charity, I'll just write a check. In many cases, even though it may be slight, you are still being philanthropic to the government and not maximizing your impact with regards to your finances and the impact that you'd like to have to charity and or the taxes that you need to pay. So it's something worth pursuing, even if you don't feel like you're a large giver, because it can have a large difference. And that is not just true for the Boy Scouts of America. That can also be to your church, everything else. And so you might be able to make that slight adjustment or recommend that slight adjustment to your friends that might be over 70 and a half as well. Went ahead and had a little fancy slide that showed how RMDs work. And so make a long story short, by actually creating that QCD, you're reducing your taxable income, right? Because the RMD was going to say you need to take $24,000. When you do a QCD, it meets that threshold, but now instead of needing to take $24,000 out, you now only had to take $19,000 out of your IRA. So that becomes a slight difference. And in general, you can make that gift to various different types of charities. You can also, think about, and it gets kind of fancy, someone could make a QCD gift, and if the charity is so inclined and you had an agreed upon strategy, you get kind of fancy where someone might be willing to allow you to make a gift and then also buy insurance premiums with it. But no one's saying to do that. It's just these are strategies that are out there in the stratosphere in terms of optimizing giving when it comes to certain of these things. All right, things you need to know about QCDs. One, the gift receipt is slightly different. You don't actually receive a tax deduction because it's a pass-through. There is acknowledgement on the charity's behalf that says, you gave me $50,000. You're amazing. You made my week. However, the actual receipt itself does not say you get a $50,000 deduction. Why? Because that is the part where you pulled a non-taxed asset and you actually passed it directly to the charity, also avoiding tax. So that receipt looks a little bit different. The second thing is you eliminate philanthropy to the government, which I'm a big fan of, but you guys are in DC. I've heard that they actually are great philanthropy. And so you can continue to do that if you're so inclined. Another thing that I put out there, there's no step up in basis associated with, with your IRA versus a stock gift. When you pass away, the value of your stock actually goes up to the value at the time that you die. From an IRA perspective, that is not true. The value in there, once the money comes out, that's where that strategy really plays a part in there. And then you can combine the QCD strategy with a standard deduction. In general, what that means is you can optimize your taxes while still optimizing your giving. Also, things to know, it's a great tool for you to accelerate your bequest. A donor may, cross over the threshold of 70 and a half, and they are now in a place where they're going to be taxed on this money when they pull it out anyway. They can actually consider ways to accelerate their bequest as well as maximize their taxes. With Secure Act 2.0, one of the major things is that in 2024, the QCD limit will be inflation adjusted. And that means that there will be no $100,000 cap starting in 2024. And with inflation, pushing itself at 5 or 6%, that number could be 105 and, continue steadily up. And so this is a strategy that, may relieve some people and really becomes a real option for, scouting support into the future. Other rules that are associated with it, there is a possibility of doing a gift annuity. It's $50,000 per person. And technically, if you are married, that means that you could create $100,000 joint life gift annuity or potentially create $100,000 CRT. CRTs are expensive to maintain. And so $100,000 becomes a question of, is that a large enough CRT for it to make sense, but it's a part of the law. And so it's something to put out there for your consideration. Some other rules associated with it is that the QCD kind of requires that you have a 5% rate associated with the gift annuity. In many cases, that's not a problem. But I did want to have my caveats there. Once again, talk to your financial advisor, but these are new rules that are in place. So when it comes to gift annuities, if you're not familiar with them, they have guaranteed payments for life, and they're based on age. The entity that is entering into the gift annuity with you is the one that's guaranteeing the payment. It's income tax deductible now. It's at a discounted rate because there's a portion of the gift that's associated with an actual gift, and the other part is the income you receive. So let's take a $100,000 gift annuity. It's very possible that you might have a $40,000 tax deduction upfront, and then every portion of the funds that you receive, there will be a portion of it that is going to be tax-free, as well as there will be taxes associated with it, et cetera. But the point is, you can direct with many institutions. The Boy Scouts of America is one of them. You can direct what happens to the remainder. So, in this case, you want to set up a gift annuity with the Boy Scouts of America. And then you want to benefit, the local council, and you have an agreement about what you'd like to do with the local council. The remainder is actually available to be passed along. There is a charge associated with us actually maintaining the gift annuity pool. However, the remainder beyond that is received. I will say, more than anything else, if you are looking for immortality or relative immortality, get a gift annuity because you're not going to die. I have seen us out. I've seen some amazing things when it comes to gift annuity. So if you're looking for a pathway for you to just be around for a really long time, set yourself up in a gift annuity. And until we create a bequest acceleration program, with my cousin Guido, you are ready, set for a long life as that process plays out. All right. So I got a really quick example for you. So Mr. Jones, he's 70 years old and has some stock. It's $25,000 with a $10,000 basis. It's got a really low dividend yield. And the dividend's only paying him $375 per year in dividends. So Mr. Jones, what he's going to do is he's going to bypass the gain and get a $10,000 deduction because that's what's available, about 40%. The gift annuity pays 5.1%, for life. So that payout is bigger. He was never going to sell the stock anyway. He worked at that company. And so he was never going to be a seller of it. So this is the next best thing for him. And then the charity will receive whatever's left over after Mr. Jones is no longer with us. So that's kind of what that process really looks like. The goal with gift annuities is about 50% or so. Technically, it's the same thing that you get in a tax deduction is what the IRS kind of believes is going to be the gift left over to charity. Generally speaking, charities expect to get about 50% from our gift annuity pool. That number normally ranges higher than that, but that's just kind of what you describe in terms of how that process plays out. If you think about 5.1%, you have a stock market that's increasing at a 7% rate. It's very possible that gift annuity could end with a 70, 80, 90% remainderment, and then less the fees, you have a substantial gift back to the local council. Gift annuities can also be deferred. So just think about it like this. You do want to make this gift today. You do want to receive that income tax deduction today. You have no need for the income. So it just becomes a pathway to set it up. And then in 5 years from now, have that income instrument in place. Especially when you're dealing with the charity, you're like, hey, but what happens if I pass away before I start receiving payments? You have a much larger remainderment, and that remainderment ends up flowing back to the council to impact the need area that was originally described and agreed upon with you and that local council, or the national office if you want to support national. I do have some examples here, but think about someone that's 59 that's going to be working for the next couple of years. They don't see a need to get more income today. And so they set up a deferred gift annuity for 5 years out as they plan their retirement, and it becomes another strategy to support their income needs in retirement. The biggest thing is that deferred gift annuities also increase. They have an increased interest rate as you defer the income because it's a time value of money strategy. Charitable remainder trust, we're going to do a really quick flyover here as well. In general, what you can actually do is you make a decision about who's going to get the income, right? Is it yourself? Is it yourself and a spouse? Is it for your children, etc.? How much income? There's flexibility around the length of time for the trust. It could be for your lifetime. It could be for yourself and your spouse's lifetime. It could just be for 20 years. Who's going to be the trustee? Is it the BSA Foundation? Is it going to be, do you have an outside provider that's going to be the trustee? And then who are your charitable beneficiaries. In terms of the BSA, we generally speaking have a requirement that at least 50% of the remainder has to go back to a scouting related function for us to be the trustee. And in many cases, most universities have a very similar policy of 50% or more for them to be the trustee, because there is substantial work to maintain those in terms of their own tax returns and other items associated with it. Did a little fancy chart for you guys, but it's a way for you to make a significant gift to a charity. It's a way for you to benefit your kids, your grandkids, parents, or someone with special needs. You get a large tax deduction up front. It's a way for you to use some excess cash or an underperforming piece of land or an appreciated stock. You're taking that Microsoft stock. You didn't want to fully give it to charity. You did want to receive income, but you did want a way to sell it. And you did not want to take that gain and have that gain hit today. So that's a way to stretch that gain over time. And then it also may allow you to benefit more than one charity. I'm currently in the process of a terminated charitable remainder trust where 3/4 of it are going to different elements inside of the BSA. And then one is going, 1/4 of it's going to an outside organization. So it allows for you to have that variability with one asset. CRTs, like I said, 1 or more lives, 20 years. Typically, it's a fixed amount, per year, or there can be a percentage. We're just flying over here. The trust are tax exempt, so you pay no taxes on the earnings or the sales within the trust. So what actually happens is, as you receive income, some of it can be long-term capital gains, some of it can be return of basis, et cetera. So the taxability of it's just a little bit different. And the goal is, in many cases, you have an appreciated asset and you're just trying to streamline the tax efficiency that you have from a personal perspective. All right, this is what I call the very flyover, but I do want to make sure I cover it just because I want you to know that this is out there. It's called a charitable lead trust. It's a way for someone to pass large amounts of money to their children at the lowest cost. Typically, if someone has estate tax issues, that's one of the ways, or they have a really large estate. I will say that the tax laws have created a scenario that in many cases, people can pass their assets to their children without estate taxes. We can envision a world where, I think it's back in the 80s and the early 90s, that estate tax limit was $1 million. Today we're sitting at $11 million for an individual. So what if we were to go back to $1 or $2 million before you start being hit with large estate taxes? That's when a lead trust really starts to make a significant difference. Just some dynamics so that you at least are aware of what this looks like. Donor gives money to the lead trust. The charity actually receives the income for that 20-year period. Then we hand back the asset to the children and on the back end. So we get the income. When it terminates, the children actually get the asset back. So it's a way to pass assets to your children, but maybe give a cure period, right? You may have children that you believe are way too young and you want them to live well, but you want them to also have a meaningful life. And so you don't want them to get the assets today because you don't want to finance the Maserati dealership or the Ferrari dealership if you gave them that cash portion today. So I used a 20-year trust. Trust is earning 7, but it distributes 5. Or you could think about a piece of real estate that's yielding value, but you believe that the real estate's going to be worth a lot more 20 years from now. That becomes another way that someone will use it, by putting an asset that may appreciate substantially more over time. After 20 years, that 2% growth means it's 1.8. That's what passes to your children tax-free. If you think about land or real estate in DC, that 2% is lightweight compared to the kind of growth that I've seen in your market. And so someone may do that with a shopping center or some other kind of asset as well. And so the tax cost in year one to transfer that is set by a lifetime exclusion. So there is some strategy associated with having that appreciation. But the thought is, how do I get this? I don't want to sell it today. And I want to gift it to my children. How do I do that? All right. And so now we are at donor advised funds. So we're flying in. I've got about 5 minutes left. I hope I haven't bored you. I think I've given you a nice little overview of a lot of different things. So donor advised funds, you may be very familiar with them from a Fidelity or anything else. You give a gift to a charity that will actually serve as the advised fund holder. They receive it. You can make you have advisory privileges. They have the right not to follow your lead, but generally speaking, unless you're giving to something that's truly outlawed, they will follow your advice. And this way it becomes kind of your investment account, but that you can actually pass assets along. The biggest thing is that for many people, it allows for tax efficiency because you can make a large gift today that makes sense and then distribute those assets for your FOS gift, for this other charitable inclination that you have, but you can do that over time and spread out the passing along of those assets. So you can create the Bill Jones Family Philanthropic Fund. So it also is a way for you to get your kids involved when you're dealing with their almost any charity, scouting, non-scouting, can receive a gift from there. But these may change over time, right? So maybe you weren't giving to scouting 5 years ago, but now it's your number one philanthropy. You can actually now redirect assets. The one thing I will say though is, let's say you had a donor advised fund and you kind of transition where it was your number one thing and now your kids are the one leading it. They may change the philanthropy that they think is most important. And so it's something to think about when it comes to plan giving or ensuring that your kids follow your desired outcome from a philanthropic perspective. That's one thing with a donor advised fund versus just creating an endowment fund with the council. That is very different, is that maybe your long-term philanthropic intent may not be followed because that advisory privilege may allow for them to divert funds that you may have desired to go to scouting. In general, they say that 79% of DAF donors are over 50 years old, and 60% of all funds that come into DAFs are non-cash or primarily stock. And so in many cases, let's say a small charity has, they don't have the ability to receive stock. The next best pathway is for them to receive a gift from a donor advised fund where the donor was able to gift the stock to the donor advised fund, turn it into cash, and then now they can just make the gift from the donor advised fund on the other side of it. Really quick, this right here was my son 13 years ago when I was working at the bank. I had a lot of papers in front of me, but I did this as a joke for Wills of Bequest because it actually meant something to me in terms of thinking about how my assets will pass along. And so in life as in death, the most significant gifts are gifts of assets, not just of your cash flow. Wills are where where you give your assets, not just your cash. This is where we want you to think about making a legacy gift to us. This is the pathway to do it. One of the interesting facts is every year, 80% of Americans give a gift, give gifts to charity in their lifetime, but only 5 or 6 make bequest gifts. That's a really large gap. Whatever we can do to close that gap, that's where the real impact actually happens. That's where the creating Friends of Scouting Forever, where we look at it and say 20% of our FOS givers are also legacy givers. All right, so here are reasons why. People see estate giving as planning their death. I do understand that. I was working on my will, felt like I was jinxing myself, right? We avoid reminders with things like I'm too busy. I don't need it yet. I just need to exercise. I don't smoke, etc. maybe I'm like John Honeycutt and I do Ironmans and stuff like that. Or no, just later. Generally speaking, those are all pathways to not yet, but we don't get to end our time clock, right? And so we want you to think about that. The average person, we spend 40 years accumulating assets, 10 years thinking about that conversation around estate planning, and 2 hours with estate distribution, right? And so really being able to think about in a greater way, having that process set up. The easiest thing for people to do is nothing. Everybody has a plan. It's just some allow the state to create their plan. So what I want you to do is take the leap. Doing nothing is not an option. Thank you, everybody, for attending. And I'll transition to questions and stop sharing my screen.
Thanks, Carlo. Very helpful, very detailed.